We will go on to our keynote speaker today. The first one is Dr. John Dayton. He will talk about angel investing. Dr. Dayton is an emergency physician and entrepreneur. He is a fellow of Stanford Medical Innovation and Device Program. He obtained his MD from George Washington Emergency Medicine Residency Training at SUNY Buffalo. He is the inaugural Medical Innovation and Device Fellow from Stanford and also an MBA candidate at Johns Hopkins Carey Business School. He advises health tech startups. He co-founded Utah's Society of Physician Entrepreneurs and is on the board of directors with Angel MD, invests with SLC Angels, and founded medforums.com, a Yelp for medical education. John, welcome to the program. Go ahead.
Thanks for having me. Let me see if I can share my screen here. I can dive right into the presentation. Does everyone see that okay?
Yes.
Excellent. So what my goal is to accomplish is to talk about why physicians should be involved with investing in healthcare, also how we can be better advisors, giving our unique medical backgrounds, and some tips on angel investing. So I'll move forward there. Obviously, this is a room of folks that are entrepreneurial physicians. I imagine there's several angel investors in the room. Obviously, we have VCs with us and folks raising money as well. So I'll try to not make it too basic, but still make it useful. So I'm just trying to figure out how to advance my screen. So as far as disclosures, Uli mentioned that I do advisory work, that I do investing as well, and just wanted to make sure that I'm upfront about all those. There's the typical disclaimer. I'm not an expert. I'm trying to learn how to be, but trying to pass along things that are helpful to my colleagues. So as I mentioned, goals, we're going to talk about angel investing and advising. So opportunities are everywhere. I'm sure several in this room have been frustrated about how something works. We saw a better way that we could do testing eyes from home, or get more familiarity with procedures we're not able to do very well, or address fertility. And based out of those situations, we thought, hey, I can do this. I can build something around it. And our healthcare system obviously right now is very ripe for opportunities to innovate. So what is angel investing? I don't know who's a big fan of the show Shark Tank. This is pretty much what my group does in one segment of it. We have a screening meeting beforehand. We do a lot of deal flow to identify the best teams that are coming to give pitches. And that will be kind of the first piece out of three. The second one is having the top teams come back and give us a pitch. The third will involve due diligence. And this is where I think physicians really have an edge because of our background, because of our familiarity with pain points. And then based on if we feel like it's a good idea and not just a good idea, but a good team and a good deal, we move forward with those companies and make an investment. Folks seek angel investing at a particular phase in their growth. Usually they've bootstrapped, they've borrowed money from friends, and they're looking for a combination of investment, but also mentorship and connections. And so they go to angel groups with this. A lot of times they need additional funds for product development, to hire employees because they found something that works and they're ready to scale. A lot of times they need it for advertising. And so, with that, scaling involves connecting with different markets, different hospitals, different practice groups. Where they are particularly, they've had their pilot, they've spent some money, they've hopefully figured out an idea with their hockey stick, and they're around in this area, and that's where we tend to be involved. This is pre VC, pre first and second and third degree raise, pre SPAC, which is getting a lot of news coverage lately, and it involves these startups seeking capital, seeking assistance, and seeking guidance. The way that the financial component of it works is angels invest in a startup business in exchange for either partial ownership or debt equity. And the way that usually works is with a safe, simple agreement for future equity. Your investment right now is going to convert to so many shares or percentage of ownership in the future. SAFE was kind of pioneered at the Y incubator, and it's become the most common funding tool. So as I mentioned, what steps are involved? There's a screening meeting. This involves looking at the companies, seeing which ones are offering the most intriguing options. A lot of times there's also a matchmaking component where if a group is coming to an angel group, if a company is coming to an angel group, but the angel group doesn't really have any expertise or network in that area, a lot of times, even though it's a great idea, those might not be the right angels to assist. And so there's a matchmaking component as well. The due diligence is the part after you've screened them, after you've heard the pitch. And this involves evaluating things like, basically you want to answer the basic questions of why them, and why now, and make sure that everything's in a row for that. What does their market competition look like? What kind of intellectual property do they own? What company corporate structure do they have? And is that going to enable them to be well positioned for an acquisition? Who's already on their cap table, or who already owns part of the company? And you want to know the background of the startup team. Is this a group of folks who have built something before and done very well, like we saw with the pitches earlier? A phenomenal team for that virtual reality surgical training, and the other two teams were strong as well. And what's their plan? What's their operating plan? So a little bit of background on who can be an angel investor. This is a SEC criteria set up in such a way that because these are high risk, high reward investments, it's a situation where they don't want people to lose a lot of money they can't afford to lose their money. So you are an accredited investor if you have an income over $200,000 a year for the last 2 years, or a net worth of over $1 million, excluding the value of your home. Accredited investors can do angel investing. They can also be involved with real estate syndications, venture capital, and hedge funds. To get a kind of a profile of who these angel investors are, predominantly male, and we see that several groups are underrepresented. They tend to be a little bit older, and that's probably a combination of experience and ability to save money. But it's good to see changes in the market with several groups getting more represented as this goes along. There was a 2017 survey of 1,700 angel investors. The median check size that these angels are writing is $25,000, which isn't a lot, but when that's combined with a group of 8 or 10 other angel investors, that's a sizable portion of something that somebody's looking for. A lot of times they go in with another angel group on a deal. And then women write 22% of the checks, and half the time are supporting other women entrepreneurs. So this gets back to the question of why physicians are enabled to be good angel investors. We have a very unique knowledge set when it comes to healthcare. And over the last few years, particularly after 2018, this has been a very valuable component of the market. It's had very high returns and has drawn a lot of interest. You can see, though, that that's not always the case. In the early 2000s and before the Great Recession, that wasn't quite there. So this is something that can ebb and flow. Dave Rose, who is an entrepreneur and angel investor, he kind of wrote the Bible on angel investing. He has his own data saying this is something that should be looked at by high net worth individuals. Obviously, it's very risky to have angel investing be your only investment and be your only component of portfolio, but he has data that shows pretty good returns. One of the reasons that is some of these companies, a lot of them are not, every company's not going to be a winner, but some are going to hit it out of the park. And so if you look at the distribution of outcome, most of the companies don't return the money. But there's a large chunk that'll give you 1 to 5 times return, and even smaller that are 5 to 10, 10 to 30. And so the goal is to have a portfolio of funds so that some of the companies that, may be a little bit cap table zombies don't keep down, your 30X, your winners. And so you increase your odds by doing things to help these companies be successful. In addition to money, you want a board seat, you want to help give your knowledge, you want to help them with their networking and connecting. Also, the more you source, the better companies you have to look at when they present before the angels. And there's also a skill set with learning how to do that. Being patient, doing your due diligence, those are key criteria. So again, why should physicians do it? We have a lot of expertise related to some of the areas that are very hot in the market right now, particularly medical devices, pharmaceuticals, med tech. For every device that people say, oh, this will be a great thing, we have a unique ability to say, well, I can or I can't imagine that becoming part of my workflow. These are the barriers that you have to get physicians to use this. This is what's going to make this interesting to insurers or to hospitals, because ultimately, depending on your specialty, those may be the groups that are making that financial decision. We also have a lot involved with influence. We have networks, we have colleagues, we know other physicians, and that's one of the things that is helpful for the startups. The last thing is addressing burnout. I know I'm probably not the only one who's felt, particularly over the last couple of years, that boy, we are just kind of cogs in a wheel, and we're not having as much involvement as we'd like and as much say as we'd like. By being involved in the innovation and the changing of healthcare, that's a direct cure for burnout. So on the flip side, why shouldn't physicians be angel investors? This is a skill that requires learning. It is high risk. Investments aren't liquid. We talk about companies that you invest in, and they call them zombies. They're not making any money. They're not dying, but they're not doing anything for your money. The goal is to move your money away from those and make sure you're having money in the companies that will do well. But these are not liquid investments. The other thing to be care of, we saw that slide earlier that showed where this is an early stage for the company's fundraising. And if the deals are not structured properly with the first round, you'll lose your equity with future raises. So what are some ways for angel investors to be successful? You want to have a strategy in place. I try to look at particularly things I'm familiar with, where I feel like I can make some contributions to the company, or I feel like I can connect them. If I don't know what my value is, and I don't know how well I can be involved. The other thing we talked about is a portfolio plan, having a lot of options in place. And then as well, that involvement, having a board seat, having an advisory role. So venture capital is a group in Utah. They look at what they call the T's for success. So number one is your team. As this company built something similar, are they familiar with this space? Are they in a situation where they can do well here? What does their tech look like? Do they have strong intellectual property? Is it something that's patentable? Is that something that's going to keep competitors at bay? The other thing is total addressable market. We looked at the fertility clinics. That's obviously an undermet market. And so this company is going in to serve a greater community that wants that care. Other thing you want to look at is traction. Do they have a minimal viable product? Do they have 510K approval? Have they gone through other types of FDA registration and approval? And then timing is the big thing. Why this team? Why this innovation, and why now? Something that comes too early, you'll waste money where the infrastructure is not ready for it. Telehealth being introduced 20 years ago, pre-broadband, is a wonderful idea, but the capacity is not there for it to be utilized. And then the last thing is your triple diligence. You just want to make sure you do a great job checking everything along those lines. So when we talk about physician opportunities, these are some specific groups that focus on portfolio investments of healthcare innovations. Global Health Impact Fund is based in Northern California. They're involved with sourcing companies, involving ones that look good and bringing them into portfolio for their funds. Angel MD has a similar process. They're kind of a matchmaker for innovators and physicians. They realize the value proposition of physicians funding the first round to get something to market. And that's very helpful when you go to continued raises. And not only are doctors going to use this, they've showed with their money that they'll invest in this product. And then Med Mountain Ventures is another one that's built around products. Two interesting ones that have came out recently. If you use Doximity, and there's kind of some funny criteria. If your picture's up, if you've made an update, you probably got an email within the last couple of weeks saying they are raising an IPO and they're reserving 15% of that space for physicians. This group has, they've increased their valuation remarkably over the last decade. Some of the folks involved with Doximity are involved with another fund called Rock Health. That was the first fund to focus on digital health, and they've done very well for themselves. Startup Health is another group that does this. They also announced within the last week or two that they have what they call their Moonshot Fund. This is a group that's invested in hundreds of countries over multiple continents. Their specific areas of focus you can see in the bottom left: getting costs to zero, increasing access to care, and the companies that do the best are becoming part of this fund that they're setting up quarterly investments for. So that's another opportunity along those lines. The other opportunity, particularly for physicians, is these are angel groups that do specific healthcare funding, but they're angel groups made of physicians and other healthcare leaders. So if this is something that you'd want to learn more about, particularly in a healthcare setting, these are interesting groups to look at. And I'll send all these slides to Julie, since I'm kind of burning through them, so folks can look at those. And if you have any questions, obviously hit me up. Another group, when we talk about physicians being involved in innovation, obviously Innovator MD is leading the charge. The pitch events at Angel MD are phenomenal. The first one I went to had Cure AI, which went on to make a huge deal with Fujifilm, and then Sidekick out of Iceland that signed a $189 million deal with Pfizer within 6 months. This team is great at sourcing great investments. And I imagine the pitch event will be part of the upcoming Congress. Yes. Another group that's very involved with innovation is called Node Health. These are a bunch of academicians who are also entrepreneurial, and their goal is to have evidence-based health solutions, and they help connect these to their networks of hospitals, insurance companies, and other stakeholders. And so along those lines, how do you not just be a good investor, but how do you add value to these companies, which ultimately adds value to your investment? We talked about the advisory role, your network, being involved, our unique expertise. And then out of that, you have company equity. You improve healthcare and you reduce burnout, which are major things. And so I don't want to go over time, and I realize I've gone over my edge. I have a couple more slides, or I'm happy to take questions, whatever you prefer, really, because I don't want to take anyone else's time.
Let's do questions.
Sure.
Divya Chander, go ahead and unmute yourself and ask your question.
So one thing that a lot of startups run into is in this sort of excitement to get early investment, they can actually accept lots of small investors and create a cap table that later, if they want to scale, venture capitalists don't consider to be an investable cap table. I wondered if you could address that.
Yeah, so one way that we address that, when we have 8 or 10 angels from our group, we're not every single one named on the cap table. We form an entity, we're on the table as the Salt Lake Angels, we might be next to the Park City Angels, so that first round is just 2 entries instead of, representing the 10 or 25 investors that are components. So that's a major benefit to keeping the cap table kind of uncluttered and causing problems with future raises.
Do you form syndicates? It sounds like you're saying.
I say that again, I'm sorry.
So you form investing syndicates is what you're saying?
We do, yeah. The gentleman that leads our angel investing group is a lawyer. He builds those syndicates, and part of what we pay for annually is involved in him making that, doing that legal work.
Great. What is your take on crowdfunding?
So yeah, so I think it's very interesting. Initially in the presentation we talked about that the SEC wants to protect people from losing a lot of money. The traditional check is somewhere between 10 and 25 grand per person. The nice thing about crowdfunding is that you don't have to have a $10,000 to $25,000 check. It's something that someone can be involved in at a smaller level. I think it depends on, just like anything else, the combination of how well sourced those crowdfunding groups are at finding companies to invest in, how much you can be involved in the diligence. One maybe negative is that as one of the main early investors who is writing a bigger check or represents a group by writing a bigger check, you're able to get a board seat, you're able to advise them, you're able to help them that way. I don't see that component with crowdfunding, but if you're a passive investor, that's not necessarily negative.
Great. And Divya asks, how does that affect future VC investments?
With crowdfunding?
Crowdfunding, yeah.
I'm not sure, to tell you the truth, and it's such a new thing over the last couple of years that I don't think we have enough longitudinal data to see that yet.
And Sergey asks about SPACs.
Yeah, so this is fascinating. This is obviously much farther down the road than the angel stage. And another speaker who's more VC based is better to speak on that. But it's interesting. What?
Yeah, go ahead. But we have a VC that'll be presenting. So
the interesting thing about SPACs, positives or negatives, they have really just paced investing. There was a Rock Health report showing that with the advent of SPACs, there was more money invested and more companies funded in digital health in the first quarter of this year than the last 2 years combined, as these companies went from the traditional IPO to the SPAC, back to the SPAC model. So there's already people saying scale it back. There's already people saying, you know, when these big companies are combining with the shell group, then is that really the best thing? But ideally, this shell group and the SPAC are a group of individuals who have shown that they can find an innovation and scale the heck out of it, which is what you want for your fundraising.
Yeah. Thank you very much, John. I really enjoyed it.